Well, for more analysis on international markets, I'm joined by Nathan Bell, Head of Research at Peters McGregor. Nathan, good morning to you. Great to have you with us. We'll come to some of the other elements that we're looking at in European markets, but I did just want to touch on, of course, this German election result that we have had coming through this morning. We're looking to the euro, paring back some of its earlier losses, but continuing to sit 0.3% in negative territory. This, of course, after German Chancellor Angela Merkel securing a fourth term in leadership, but it certainly wasn't the result that we have been anticipating.
Look, I think this is all good news coming from Europe. Despite all the negative headlines, the European economy is actually doing quite well. And last year, believe it or not, it actually grew slightly faster than the US, which I don't think too many people are aware of. I think last year, probably 12 or 18 months ago, the bank share prices were really down. There was thoughts that Deutsche Bank might have a real problem with its financial situation. And we saw a big shift towards populist politics in Europe following what had happened in the US, and I think everyone got very afraid, and that's why the bank share prices dipped. But since then, the news has really been all good for the European banks, which we're invested in. They're much safer than what they have been. People are moving away from those populist candidates, despite what the news headline said there. And we've got more elections coming up next year, one in Italy. And as long as these continue to show that trend, then I think the European economy is going to continue to do well, and so will stocks.
Just with that in mind, I mean, as you mentioned, that the movement that we're seeing in European bank share prices has been very present, particularly, of course, if we look to the German election. We've also now got more emphasis being placed on the Italian election coming up. In terms of, I guess, picking the winners within that space, are there certain countries or certain lenders that you are more bullish on?
Yeah, so our current banking exposure, we actually own a couple of banks in Italy. Remember, Italy's been one of the eyes in the pigs that everyone was so frightened about in 2011, 2012. And actually, one of the reasons we're there is because, partly because of the five-star popular movement there in politics, but also it's just Italy's been really, really slow to recapitalise its banking sector. So the sector should have been cleaned up 3 or 4 years ago, and it hasn't been done, and people have got very frustrated with basically what's been depression-like conditions in Italy and Greece also. We've had youth unemployment of 50%, which we can only really imagine what that must be like here in Australia, given we've had about 27 years now without of positive growth. So Italy's recovering from that now, and I think because the economy is getting better, the banking sector is getting cleaned up with the help of the government. I think that's the reason why people are starting to steer away from those populist politicians, and also they've seen what's happened in America with Donald Trump, and I don't think anybody wants a repeat of that.
Just with that in mind, also interested just to get your take on in terms of the UK financial sector as well. I believe Lloyds was a stock that you were watching quite closely in previous times. Now we do, of course, look to whether or not Brexit negotiations will hit the ground running. This German election had been very much the deadline, as it were, for UK PM Theresa May. In terms of how we proceed forwards, how does that impact perhaps your view for the UK financial sector?
Yeah, so we still own Lloyds Bank, and we also own another bank called Metro Bank, which has only been around since 2010. But I think one of the biggest problems of Brexit is that because no one's certain of what it's going to look like in a few years' time or how fast the transition is going to happen, businesses have been afraid to invest. And I think a lot of people have been wary about making big investments in homes. And if you look at something like Lloyds, which is a purely domestic UK bank, people are very concerned that parts of the city, so a lot of big investment banks are actually going to be moving their head office towards Europe. And again, that's just another headwind for the UK economy. But if you actually have a look what's going on the individual financials of these banks, it actually looks pretty good. Lending's ticking over, albeit quite slowly. The banks are a lot more healthy compared to when they were going through the GFC. And things are going along, and they're probably really plodding along. But that doesn't mean there's not opportunity there. But I think the big opportunity caused by Brexit has passed, and I think the fears have actually died down as well. It's really now just about the timing of it and how much it's going to cost the UK to make the exit.
Just to make that comparison point, of course, here domestically on the ASX 200, we look so much to the financials and their performance. Just how do you look at the financials in Europe against here at home on a comparative basis?
Yeah, well, this is one of the reasons why we've got most of our bank investments at the moment in Europe, is because if you look at our European banks, on average they trade around 1 times book value, which compares to the big four Australian banks. It's, I think, 2.1 times book value on average. The dividend yields in Europe are 3 to 4%. In Australia, they're 6%. But there's actually going to be a lot of growth in the European banking sector because they're still recovering from, as I said, almost depression-like conditions in parts of Europe, whereas Australia is potentially still sitting on a huge housing bubble. Europe's already been through that. They've been battle-tested over the last 8 years. Things are finally getting better and dividends are going to go up. And that's quite a contrast to the Australian banks where dividends are under pressure. And if there is a big problem with the housing sector at some point, then obviously that's going to be very bad for dividends and bank profits.
Now, just lastly, one of the headlines that, of course, we've been watching emerge over the last week are storms in Puerto Rico and that Latin American region. Keen to get your take on what this means for the Latin American cable TV and broadband provider Liberty Latin America, because this was a stock, in fact, we were discussing, Nathan, only a few weeks ago.
Yeah, so last week I came on and made the case for why we thought Liberty Latin America was very undervalued and why it's one of our largest positions. And then a couple of days on, Puerto Rico was in the middle of the storms, and now it's not going to have electricity or power for 4 to 6 months. So it just goes to show you that the extra risks you have to deal with when you go to these parts of the world. But it hasn't changed the investment case, and the good news, if you can call it that, is that Puerto Rico is about 8% of revenues for Liberty Latin America, so it's not going to have a huge impact on the company. But I think, again, it's what we're really looking for, particularly in an environment of very high asset prices, is we're looking for where bad news is obscuring the high value of underlying assets, and we think Latin America is a place where internet broadband usage is only half what it is in the developed world. So that's a runway that's going to take another decade to come. So even though there's been a few storms and that doesn't help in the short term, long term the investment case hasn't changed.
And just in terms of when you speak to the long term, I mean, what time frame are you actually looking to here?
Yeah, I mean, I think the long term in this case is actually this should be a great business over the next 10 to 20 years. And I say that because there's actually a lot of consolidation that can happen in that part of the world. So we expect Liberty Latin America to be making acquisitions over time and really being a leader in that consolidation. But I also think as an investor, you need to be right over sort of 3 and 4 year time frames. I don't think most people have the patience to actually see out returns longer than that. But the company's really down at the moment because it's a spin-off, and a lot of big investors don't like owning the small part of the spin-off. Liberty Latin America is only 1/10 of the size of its parent that it was spun off from. So I think once its operating earnings improve over the next couple of years, again, I think the share price will respond to that. And it just looks very, very cheap to us at the moment. It's trading more like a boring telecommunications company, and it's a broadband internet provider, which is a much more superior business.
On that note, Nathan Bell, we will leave it there. Great to have you with us this morning. Thank you.
Thanks, Natalie.